Well, a very good evening and thank you for joining us on India Business Hour. I'm Ashmit Kumar and here are the headlines that we're tracking at this hour. Stock markets stumble for the first time in 2023. Sensex loses over 600 points. Nifty declines by 1%. Metals and realty stocks lead the fall.
Many challenges right now around the world. In fact, India is probably the exception.
India is the exception in a challenging global environment, says Satya Nadella, even as he remains cautious in the short term, expects pockets of growth to emerge even if economies go through a recession, and remains bullish on the long term. That's an exclusive. Nadella expects the next 2 years to be challenging for tech companies after the pandemic-fueled growth, admits that Microsoft is not immune, and says tech sector must look inwards to boost efficiency and remain competitive. The Union Cabinet approves an initial outlay of close to 20,000 crores for its green hydrogen mission, targets investments worth 8 lakh crores and hydrogen production capacity of 5 million metric tons by 2030. The mission aims to give incentives worth 17,000 crore rupees for electrolyzer and green hydrogen manufacturing. Crude oil prices tumble as fears over global growth and COVID surge in China cast a shadow over demand. Natural gas prices in the US and Europe fall to their lowest level in nearly a year after a warmer start to the winter season. Setback for Google. The company appellate tribunal refuses to stay 1,337 crore rupee penalty imposed by CCI on the tech giant, says economics can't be allowed to run astray, orders the company to pay 10% of the amount. Google hints at moving Supreme Court to challenge the NCLAT order. Twist in the DMRC Reliance Infra arbitral saga. The PSU tells High Court the Delhi government has refused to pay 3,500 crore rupees for the arbitral award, while the centre has said that it is considering but has not committed to a payout. The DMRC says that it will try to raise necessary funds from the open market and through a loan from the centre. NARCL emerges as the highest bidder for Shrey Twins ahead of Autumn with a net present value of 5,526 crores. NARCL's bid includes an upfront cash payment of 3,180 crore rupees. There were only 2 bidders in the final lap after Varde Arena Consortium dropped out of the e-auction in the second round. Sam Bankman-Fried, the founder of bankrupt crypto exchange FTX, pleads not guilty to fraud charges. 2 of his colleagues have already pleaded guilty and are cooperating with investigators. Higher household expenditures, lesser spend on health and more savings. That's the sentiment among consumers as we enter 2023, according to the Axis My India Consumer Sentiment Index for January. Well, first up, a look at the day's market action. The Lal Street saw an all-round fall and failed to hold on to this week's early gains. Nifty and Sensex fell over 1%, with metals and realty leading that slide. Both those indices saw a fall of over 2%. Banks and mid-caps also fell in line with the benchmarks. However, pharma counters showed some resilience. Nigel D'Souza is joining us now with a quick wrap of the day's market action. Nigel.
Well, global markets itself were jittery overnight on the back of recession fears, and that's what weighed on global stock markets. For the Indian markets, participation was back, which wasn't the best thing because we did see quite a bit of selling pressure all through the trading session. The bigger problem was that the broader markets that outperformed for the last 2 sessions, well, it underperformed in today's trading session with way more number of stocks declining in comparison to the number of stocks that were advancing. Metal stocks, well, they've given away most of those gains that we saw. Remember, pricing did see a bit of a bounce in the last few sessions. However, the recessionary fears are back, and the problem is, will China slow down yet again? And that's why ferrous and non-ferrous stocks, they did come in for selling. Coal India, there was an additional news print that did come out, and that was that the wage hike has been approved to the tune of around 19%. The street believes that in the near term, things could be under some pressure because the pass-through may not be possible in a pre-election year. Tech stocks, well, they did see some pressure all through the trading session, and they're not out of the woods as yet. Infosys and Wipro, both of them did end in the red. The problem, though, is that the heavyweight stocks, Reliance Industries and the HDFC Twins, well, they ended with cuts of more than 1%, and that's what put pressure and contributed to a bulk of the 200-point downtick that we saw on the Nifty itself. The Nifty Bank, that's been the saving grace. The problem is today, it broke the 20 DMA and ended below those levels. So you had IndusInd Bank that was lower, RBL Bank, as well as Canara Bank. All of them did end with cuts of around 1% to around 3% odd. Remember, they've had a big run, but they did come in for some selling today. And IndusInd Bank, they came up with the quarterly numbers, which didn't look that bad, but that stock did see a bit of a knock in today's session. Well, a couple of other quarterly updates as well did come about. Vedanta and Avenue Supermarts, but both those two stocks as well did end with cuts. All in all, it was a down day for the markets. The Nifty ended at the low point of the day. Interesting to see whether or not we go and test the December 2022 lows, or in fact, we do see a bit of a bounce from these levels.
Right, Nigel, thanks a lot for that. Now, from the stock market to the energy market, crude prices softened today after weak China data and fears over a global recession dented demand outlook. The IMF has predicted that US, Europe and China could face a recession this year. Natural gas prices, meanwhile, in Europe and US have also dropped to levels seen before Russia's invasion of Ukraine. The fall has been triggered by warmer than expected temperatures and higher than normal stockpiles in the continent. Meanwhile, the big newsmaker this evening, Microsoft Satya Nadella, says the next 2 years will be challenging for tech after a pandemic-fueled growth. Tech stocks continue to feel the jitters in the new year as well. Apple's market value, in fact, has dropped below the $2 trillion mark. Apple and Amazon have each lost $800 billion in market cap. Last year, speaking exclusively to CNBC-TV18 Shireen Bhan, Nadella said that he remains cautious in the short term, but bullish on the longer term. The Microsoft CEO expects pockets of growth to emerge even if economies go through a recession. Nadella called India an exception amidst a challenging global environment.
Inflation, recession fears across most parts of the world at this point in time. Interest rates continue to move higher. Is it all flashing red on your dashboard? Is there any sign of green at all?
I mean, it's clearly many challenges right now around the world. In fact, India is probably the exception. There are parts, India, Middle East, Latin America, some of the other parts of Asia are the things that are green. And I think Europe and the United States are going to be challenged. I mean, the United States, not yet, but I think 23 will be much harder. So yes, we want to be very cautious in our outlook in the immediate term. Long term, I'm very bullish of us coming out, right? Because there are two cycles, I think, Shireen, that are happening. One is a supply cycle that's a very long cycle. That's a secular shift. We're not going back to 2010, 2011, because of the geopolitics as well as essentially the rejiggering of supply chains. I think we're going to have a supply cycle that's going to persist. The demand cycle is going to be a classic demand cycle. There will be some economies that will go through a recession. Some may be deep, some may be minor. And then inside of that, there will be pockets of growth like India. And so I think for us as a global company, we're not going to be immune from what's happening in the macro. We will have to also get our own sort of operational focus on making sure our expenses are in line with our revenue growth, manage the short term, but make sure we're investing for the long term.
Many CEOs are now talking about having to respond to the new economic reality. What is that going to mean, not just for Microsoft, but for the tech sector in general? Are we likely to see more pain, especially when it comes to retrenching, downsizing, margins going to be under pressure, guidance going to be a downside risk to that as well?
I think overall, quite frankly, whether it's for us as Microsoft or the tech sector, it's going to be very important to look inside and say, are we as efficient as we need to be competitive? I mean, at the end of the day, just because we are a technology company doesn't mean that we are the most efficient at what we do. And so as the paradigm has changed, as the bar has risen, we have to measure ourselves with the new bar. So definitely and also the growth picture has changed, we have to have operating expenses that need to be aligned. So definitely we are going to look at all of that, and it means that we're not sort of immune, as I said, to the global changes. But the one interesting thing to your point, though, is tech industry employment is not tech employment.
Yeah.
That, I think, is the key divergence that needs to be well understood, because that, I think, is positive, by the way, for the tech industry long term. Because if you look at it, overall tech jobs is actually increased. The tech jobs now are coming in financial services, in energy companies, in retail, manufacturing, and that's healthy because in the long run, all those employees in all those industries are going to consume more tech infrastructure, right? When we think about our cloud business, Long term, we're bullish because of the fact that there's more employment outside of the tech industry of technical talent. And so that's, I think, what we are banking on.
No, I think you underscore the labor market resilience aspect. But, you know, what we've seen, especially as far as the stock markets are concerned, and I know that CEOs often say that don't focus on what the markets are telling you, but they seem to be suggesting that there is significant pain in store for the tech sector. How do you read what's happening with the way that the markets have corrected, specifically the tech stocks, and what that signals?
You know, for me, look, I'm never the one who would ever say ignore the market, because the markets are smarter than us all. I think they are reflecting on is, look, where is the growth coming from? And how should we think about normalizing for that growth? And so I think stock performance, economic performance are not exactly the same. But the key for us as a tech industry, I always go back as a percentage of GDP. The simple question to ask is, do we think tech spend will increase or decrease? If we believe software and digital infrastructure is going to be important in construction, in energy, in manufacturing, long term, then you have to be long on tech industry. But will we have to go through our own cycles around productivity? Absolutely, like anybody else. But that's at least my perspective. I wouldn't look, the only reason why I would say ignore the short term is because in the long run, we would be fine for demand. But in the short run, what we have to focus on is our own productivity and making sure we are at the efficient
How would you quantify short term and long run?
I would say the next 2 years are probably going to be the most challenging because after all, we did have a lot of acceleration during the pandemic, and there is some amount of normalization of that demand. And on top of it, there is a real recession in large parts of the world. And so the combination of pull forward and recession means we will have to adjust. And that will cycle through the demand cycle and, in fact, come out of it with what can be another massive growth cycle for the tech industry.
Well, you can catch that entire conversation with Microsoft CEO Satya Nadella tomorrow, right here on CNBC-TV18. In other developments, the Union Cabinet today approved the government's national green hydrogen mission with an initial outlay of 19,700 crore rupees. The mission aims to make India a global hub for production, utilization and export of green hydrogen and its derivatives. Parikshit Luthra is here joining us with more on the mission, its goals and what's the expected outcome from this mission.
Out of the total allocation of 19,744 crores, roughly 13,000 crore would go towards direct incentives for green hydrogen generation and 4,500 crore for electrolyzer manufacturing in the country. The ecosystem for electrolyzer and green hydrogen generation is at a very nascent stage in India right now. The next step would be to have stakeholder consultations and roll out enabling schemes for these incentives. Sources say the government will be inviting bids for electrolyzer and green hydrogen manufacturing. The incentives will be for 5 years. A dedicated R&D fund will be set up with efforts to bring in private sector and venture capital investments as well. The initial outlay of the National Green Hydrogen Mission is planned till 2030. The plan aims at achieving 5 MMT of green hydrogen production capacity till 2030 and 60 to 100 gigawatt of electrolyzer capacity. The National Green Hydrogen Mission is also aimed at capturing a large share of global trade in green hydrogen and derivatives.
This will really help us develop initial projects to the extent of 5 to 6 million metric ton, as is envisaged by 2030. A very comprehensive policy, I would say. Details will come up. The process initiated by Ministry of New and Renewable Energy, engaging all the ministries, relevant ministries, as well as stakeholders. It was a complete consultative process, and we hope we will have a very detailed policy coming out very soon.
Some of the industrial segments, whether it is refineries or fertilizers and such, would be obligated to buy some of the green hydrogen that some of the part of the hydrogen that they consume from greener sources, right? And that would jumpstart the virtuous cycle of creating a demand good enough in Indian terms.
Well, on the macro front, India's services sector activity saw a sharp pickup in December, with the S&P Purchasing Managers Index rising to 58.5 versus 56.4 in November. The number has remained above the 50 mark for 17 months in a row. With this, the composite PMI, which is a combination of manufacturing and services, has risen to nearly 59.4 versus 56 in November. Well, a quick look at the other headlines. It's a setback for Google. The company appellate tribunal refused to stay its 1,300 crore rupee penalty imposed by CCI on the tech giant. The tribunal, while observing that economics can't be allowed to run astray, ordered the company to pay 10% of the amount to CCI. Google has hinted at moving the Supreme Court to challenge the NCLAT order. Delhi Metro Rail Corporation tells the Delhi High Court that the Delhi government has refused to pay 3,500 crore rupees for the arbitral award to Reliance Infra, while the centre has said that it is considering but has not committed to a payout. The DMRC says it will try to raise necessary funds from the open market and through a loan from the centre. The National Asset Reconstruction Company has emerged as the highest bidder for the Shrey Twins ahead of Autumn. Sources tell us that the NARCL has offered over 5,500 crore rupees in terms of net present value. This includes an upfront cash payment of around 3,200 crore rupees. In startup news, BharatPe reported a loss of over 5,600 crore rupees, rising 3 times more than its FY21 figures, even as its revenue grew by 169% during this year. BharatPe said that the total loss of close to 5,600 crore rupees included an extraordinary item pertaining to loss in change in fair value of compulsory convertible preference shares amounting to about 4,800 crore rupees. Excluding this, the operating loss stood at about 800 crore rupees this year. In less than a month, Finance Minister Nirmala Sitharaman will rise in Parliament to present the Union budget. In the 11 months since the last budget was presented, the government has made headway on some of the last year's proposal, but is struggling on a few others. Timsy Jaipuria has the hits and misses of Budget 2022.
When the Finance Minister presented Budget 2022, India was just coming out of strict restrictions imposed due to the pandemic. So the budget focused on getting India's growth engines back online. What no one anticipated was Russia's invasion of Ukraine less than a month later, or the spillover effects this would have globally. The months that followed have not been easy, with multiple headwinds that threatened to push India off its course from becoming a $5 trillion economy by 2025. But on a few major budget targets, we have managed quite well. Take fiscal deficit, for instance. Budget 2022 had set a fiscal deficit target of 6.4%, and as things stand, the government looks to be on track to get this level. One big reason for this is tax buoyancy. Budget 2022 had estimated direct tax collections of 14.20 lakh crore rupees for the current fiscal, higher than the target that was set for last fiscal, which was at 14.10 lakh crore rupees. And after adjusting for refunds, the net direct tax collections so far this fiscal stands at 11.35 lakh crore rupees. That's 80% of the target already achieved. And with the last 3 months left, which usually see higher tax collections, so the target could be surpassed too. In this regard, indirect tax collections also offer strong support. GST collections have averaged above 1.4 lakh crore rupees per month, which puts the government on a comfortable footing. Including December collections, GST mop-up stands at 13.4 lakh crore rupees this fiscal, with the festive season turning in nearly 20% higher mop-up than a year ago. The government also seems set to deliver its promise of an aggressive 7.5 lakh crore rupees in capital expenditure. Some of its other hits include the introduction of a sovereign digital currency, for which the RBI has launched pilots, forward movement on PLI schemes for 14 sectors, with a few schemes even starting disbursal of incentives, and spectrum auctions for the rollout of 5G services. But there are still a few areas where the government is in danger of missing its budget targets. The biggest, by far, is economic growth. With inflation prompting a string of aggressive rate hikes and global tremors finding their way to India, the big headline number of 9.2% growth is no longer realistic. The most recent RBI projection says that India is poised to grow at 6.8% this fiscal, and the fact that India remains one of the fastest growing major economies in the world is a little comfort. Another miss is the replacement of the Special Economic Zones Act with a new legislation that would enable states to become partners. But the Desh bill remains stuck in interministerial discussions. The government has also had trouble in containing the expenditure, especially the high outflows on account of its free food scheme, fertilizer subsidies, and a larger import bill. Spending on all of these three has exceeded the budget estimates. The government has tried to control a lot of this. For instance, it has managed to merge PM Garib Kalyan Anna Yojana with the NFSA to bring down the food subsidy bill. Another area the government has not managed to meet its own estimates is on divestment. Against a target of 65,000 odd crore rupees, the government has managed to divest only 31,000 crore rupees. The government has also not been able to introduce the Banking Amendments Law Bill, which would enable privatization of banks. So, the promise to privatize at least 2 public sector banks this year has not been kept. It has also not made much headway in convergence of the old and the new direct tax regimes, and its intent to push agricultural reforms that would offer farmers a better price discovery mechanism remains just that, an intention. Now, all of these will have to get done sooner or later. So we'll have to see whether the way forward on these promises finds mention in Budget 2023 or not.
Right, with that, it's time now to slip into a very short break. But coming up on the other side, higher household expenditures, lesser spend on health and more savings. That's the sentiment among consumers as we enter 2023, according to the Axis My India survey. Details when we return.
Yeah, Ajay, look at your dad. Will we be the same at his age?
Absolutely yes, if we plan our future like him.
How?
My father had invested in LIC's Jeevan Akshay, which gives immediate and guaranteed annuity at regular intervals, that too for life.
Wow. But do we have to wait until his age?
Absolutely not. We recently invested in LIC's new Jeevan Shanti, which gives deferred annuity, which means regular income after some years.
I see.
LIC!
LIC's annuity plans give 10 annuity options and flexibility in receiving regular income. LIC, हर पल आपके साथ.
Being the father of 2 young daughters, and I want every daughter in this country to have same opportunities like we provide here at Network 18.
Future is hers. We are rewriting rules, reimagining equality, and redefining what power means.
So spread your wings, break the ceiling, create magic. Most importantly, be yourself.
A mega initiative to make gender parity an attainable reality. HSBC presents CNBC-TV18 Future Female Forward, the Women's Collective.
Welcome back. Now, employees of 3 Maharashtra government-run power companies have called off their strike. The decision came after Deputy Chief Minister Devendra Fadnavis assured that there would be no privatization of the electricity distribution sector. Thousands of employees had begun a 72-hour strike in various parts of Maharashtra. They were protesting against parallel licenses being granted to private electricity distribution companies. A quick look at some of the other headlines, starting with the latest in the CG Power alleged bank fraud case. The CBI has filed its charge sheet against the company and others, including its then promoter, Gautam Thapar. The investigating agency is probing charges of fraud of over 2,400 crore rupees. The Supreme Court has stayed the Allahabad High Court order directing Uttar Pradesh government to hold urban local body elections without reservation for other backward classes. A bench presided by Justice D.Y. Chandrachud and Justice P.S. Narasimha has asked the State Backward Classes Commission to file a report on the political backwardness of the OBC. Air India says it has initiated action against the passenger who urinated on a female passenger in a flight from New York to Delhi. The passenger has been banned by the airline for 30 days, which is the maximum it can do. Air India, meanwhile, claims it has reported the matter to the DGCA. An FIR has been lodged already and an internal committee has been formed to probe the matter further. Cricketer Rishabh Pant, who got injured in a car accident, has been airlifted to Mumbai from Dehradun for further treatment. He will be treated at the Kokilaben Dhirubhai Ambani Hospital. He will undergo surgery and will be monitored by the BCCI medical team. The Indian cricketer met with a road accident on December 30th when he was on the way to his home in Roorkee. In international news, Russia claims that the death toll of its soldiers after a Ukrainian missile strike has risen to 89. Officials say that the attack happened because the soldiers were using mobile phones in defiance of a ban. This helped Ukraine track their coordinates and launch precision strikes. It is the largest number of deaths Russia has now acknowledged in the war so far. FTX co-founder Sam Bankman-Fried has pled not guilty to 8 criminal charges pertaining to the collapse of his cryptocurrency exchange. The 30-year-old was indicted on charges of conspiracy to commit wire fraud, securities fraud, and money laundering, among other things. The New York judge has set a tentative date of 2nd of October for his trial. After 3 years, Twitter is all set to reverse its 2019 ban on political advertisements. The company has decided to allow cause-based advertising to facilitate public conversation around important subjects. Twitter says it wants to align its advertising policy with that of TV and other media outlets. As we enter 2023, how is consumer sentiment likely to shape up in the year ahead? Well, according to a survey by Axis My India, people spent more on household expenditures and less on health. The survey also found that Indians have been saving more. Shilpa Ranipeta now joins us with the key trends. Shilpa, over to you.
Higher household expenditures, lesser spend on health and more savings. That's the sentiment among consumers as we enter into 2023, according to consumer data intelligence company Axis My India's Consumer Sentiment Index for January. Now, the Net Consumer Sentiment Index score, which reflects consumer sentiment in the past month of December, has improved over the last month to 8 points, with the score hovering anywhere between 7 to 10% in the last 6 months. Now, this survey looks at household spends and trends covering media, consumption, entertainment and tourism. Now, a sample size of around 10,000 people across India was considered, 70% of who are from rural area and the remaining from urban, and a majority of the respondents being male. Now, the biggest takeaway from the survey is that household expenses in December has gone up or remained same for 91% of those surveyed, and of this, it has increased significantly for 40%. Why? Now, that's largely because of rising inflation, higher health-related expenses, and also reduced income. Now, as a result, 86% are spending the same or more on essentials, while discretionary spending has gone up for just 7%, with 88% spending the same as last month. Now, these numbers being slightly lower than the December index indicates that there is some improvement in sentiment, especially compared to the first half of the year. Also reflected in the fact that 95% of families are getting out more for short vacations, and as we enter into the new year, financial goals are also taking precedence, especially amidst rising inflation and pandemic-related uncertainties. Now look at this, 34% want to save for their child's education, 14% for marriage, and 8% to buy a house and to save for bad times as well. And looking ahead into 2023, what do consumers want? Well, they want more employment opportunities, a better salary hike, a curb on inflation, and better standard of living. Now, this overall, Axis My India says, reflects the current environment of resilience and cautious growth.
Well, with that, it's a wrap on this edition of India Business Hour. Thank you so much for watching. News and updates continue right here on CNBC-TV18.